Good morning, and thank you all for joining us today for the next webinar in our Feeding Faith Leaders with Community Fervor Spring 2021 series entitled Pro Formas, Getting Familiar with the Basic Tool of Real Estate Finance. My name is Tim Block, Senior Program Director with Enterprise Community Partners, and I have the pleasure of leading Enterprise's faith-based development initiative in the Southeast. We appreciate all of you taking the time to be here with us today, as it is our pleasure to bring to you these webinars that are designed to be a combination of both high level and deep dive trainings that help participants like yourselves understand the basics of developing housing and other community facilities that can serve congregations and community members. Before we continue with today's program, a few housekeeping items. First, the webinar is being recorded. We ask that you please use the Q&A feature and not the chat when asking questions for our presenter. And the chat feature can be used to interact and engage with fellow participants. Shortly following the webinar, we will be making available the recording, presentation slides, and a survey via email to all participants and placing them on the resource page of Enterprise's website. With that, let's jump right into today's webinar. It is my pleasure to introduce our dynamic presenter for today's webinar. Louis Keong serves as Real Estate Development Director for Enterprise Community Development, Inc. In that role, he is responsible for managing the entire development process, including acquisition, deal structuring, design development, financing, public approvals, marketing, and leasing and sales. Louis is a seasoned professional with more than 25 years of experience in the acquisition, development, leasing, and sale of commercial real estate. Needless to say that in those 25 years, he has put a few pro formas together, and we are thankful that he is willing to share some of what he has learned along the way with us this morning. Louis, I'll now turn it over to you, and I'll come back at the end of your presentation to help facilitate the Q&A portion.
Thank you, Tim. I'm not sure I can live up to the wonderful lead-in that you've provided me, but I will try my best.
No pressure, my friend. No pressure.
Good afternoon, all. As Tim says, I guess I am a seasoned real estate professional, which is another word for saying I'm old. I'm really old, but I'm happy to be here to share with you as much as I can within the next 45 minutes to an hour. Some of the thought processes and some of the tools that not just I, but many real estate professional would use almost regardless of product type, whether it be affordable housing or commercial office or shopping centers. Obviously, each of those products have their own little nuances given the nature of the use of the property, but the analysis approach is one and the same. So I'm going to throw up on the screen real quickly a short agenda that I want to walk you through for a few minutes, and then we're going to go right in, and I'm going to try and build a really simple pro forma for you on the screen, and kind of tie it back to some of the items on the agenda that we talk about. So with that said, I will share screen. Great. I hope everybody can see that. So the topic, again, as Tim shared with me, was one, how to build a pro forma, which is fine. Building a pro forma in of itself is not terribly complicated. And building a pro forma in of itself as an ends is not that helpful. It's what do you do with the pro forma afterwards? So stepping aside from the pro forma aspect of it for the moment, I want to talk about the time value of money and the 6 functions of a dollar. Okay, and I'll tie it back together a little bit later. This seems a little bit different and distinct and separate from the pro forma itself, but trust me, we'll come back to it. And some of these concepts are pretty simple. The trick really is to how do you apply it to investment analysis, really, not just real estate, but investments in general. So you see there that there are the 6 functions of a dollar, which is the present value, the future value, the present value of an annuity, the future value of an annuity, a sinking fund amount, and a mortgage payment amount. So I highlighted the 2 in red that we really use. We use all of it, but those 2 we really use, and those 2 will apply to the discussion that I will have today. So present value is, again, probably the first one, which is if I give you $10 in 5 years, what's it really worth today? So what you see there is the formula. PV is the present value is equal to the future value times 1 divided by 1 plus I being the interest rate or the return rate to the power of N, which is the time period involved. So if we're going to deal on an annual basis, and you can do things on an annual basis or quarterly basis or a monthly basis, you just need to make sure that the periods and the interest rate is the same. So for instance, if I say the interest rate is 12% and we're going to do it on a monthly basis, that would be 1 over 1 plus 1 to the power of 12. If we're going to do it on an annual basis, it would just be 1 over 1 plus 12 to the power of 1. There are real formulas involved in this. Again, when I started my career long time ago, we had these things called discount tables or interest rate tables, and that's where these numbers come from, as opposed to nowadays you get on an Excel spreadsheet, there's a function, you enter the function and put in the parameters and the answer spits out. So, but I wanted to show this to you because it is important to kind of understand how we get to where we get to. So the present value, again, is equal to the future value times whatever the factor is based on that formula. Future value actually is just a reverse of that. Future value would be the present value divided by 1 plus I to the n power. We don't care about that so much in this analysis at this point in time. We do use it, but for this discussion, we're going to ignore it for the moment. And then the other one that's really important is the present value of an annuity, which means if I were to say to you, I'm going to pay you $10 a year for the next 20 years, what is that worth to you today? And I'm going to make up numbers, and let's just say at 6%, it's worth $50. In theory, you would be indifferent to whether you got $50 today or you would get that $10 a year for the next 10 years or 20 years, whatever period I said. And when we look at real estate analysis and financial viability, that's really the equation we're looking for, because we're going to look at a project, and this project's going to generate income. And we're going to say, again, at whatever given rate of return you're going to require, which is the interest rate, the I here that's shown here, does it make sense? So if the present value, let's say the project costs $10 million to build, and let's say the net income after payment of all operating expenses, and let's forget the financing for the moment. Let's just say you're going to pay it all out of pocket, out of equity. There's no debt involved. If the project costs $10 million today, and the stream of income that you anticipate collecting from that project over the next 20 years, at whatever discount rate, whatever interest rate that you're looking for, brought back is equal to $10 million, you're indifferent. If it's $10,001, in theory, you do the deal because it's positive. So it has a positive net present value. If it's negative, if it's less than $10 million, if it's $9,999,999, you'd say no because you've lost money on the deal. So that's the analysis that I go through every time. The mechanics of it is really easy. It's not that hard. That's the science part of it. There's the art. The art is, how do I project, not predict, but project what operations looks like over the next 5 years, 10 years, 15 years, 20 years, whatever your horizon is that you're going to look at. How do I model that? How do I project that? How robust do I make that model? How do I test it to say, well, what if I'm 5% off high or 5% off low? What does that look like? And then you have to also determine what return rate you're going to require. It's not as simple an answer. Depends on the market. Again, from a pure investment perspective, you also have to look at what your alternative investments are. In the absence of that, you're just grabbing a number out of the air. So if you had $10 million to invest in a deal, and this deal that you're looking at, and we run all the numbers, and the numbers we're pretty comfortable that the numbers are within reasonably accurate. And it'll generate 6 or 7% return over the lifetime of the investment. The question is, if you were to stick it somewhere else, stick in the stock markets and put it on a horse, will you beat that 7%? And if you can beat the 7%, you wouldn't invest in that deal. If it's less than 7%, you would invest in that deal, the alternative investment. So those are the things that we have to take a look at, again, from a pure investment perspective, not within the context of affordable housing, which has the mission oriented incentives as well, which is kind of totally different, and it impacts and it influences what we do on the analytical side, and means that the analytics doesn't have to make sense from a numbers perspective, but it's the right thing to do, it's the good thing to do, it's something we're gonna do. So that's kind of the thought process about whether we make a decision to do a deal or not do a deal from a pure investment perspective, shaded by and colored by the mission goals of providing housing. So I hope that makes sense. Going down a little bit. Where am I here? I'm sorry, I'm having a little bit of, well, technical difficulties here. Well, why am I not? I'm gonna stop there for a moment. There we go. Okay. So the other three functions of the dollar, the future value of an annuity, sinking fund amount, mortgage payment amount, again, those are important. We use it. We're not going to talk about that today because it doesn't apply today. I've already gone over pro forma. Pro forma is they are projections, not a prediction. The art of that is how close and comfortable we are with the projections that we make and the assumptions that we make. Back of the envelope analysis is one of the very quick and dirty ways we take a look at a deal, see whether it even begins to make sense to do further investigation and analysis. Discounted cash flow analysis is the alpha and omega of real estate investment, and to a certain extent, investment in general. So we're going to talk about that a lot today. You recall that I said earlier, the pro forma in of itself does nothing for you. It's just, it's a bunch of numbers over a period of time that you're predicting or you're projecting, excuse me, and hope that it comes to pass. Well, what does it really mean? What it really means is, what's it worth today? That's your discounted cash flow analysis. And again, as I said, I'll tie it back to before, which is the present value of an annuity. Real estate, unlike a savings account, as a for instance in a bank, the income that you receive from real estate is not steady, or it's not the same amount every single year or every single month or whatever period you're going to use. It changes. It goes up, it goes down. Sometimes you're a little bit more full, sometimes you're a little bit vacant, sometimes your expenses go up, sometimes your expenses go down. So the income that you generate from real estate goes up and down. The discounting factors that I talked about earlier are the same. It's just the numbers that you apply to, again, is different. So it's still the present value of an annuity, but the annuity amount, in fact, is not regular. It changes from period to period. And that's where discounted cash flow analysis come from. And then the net present value, as I mentioned, is what's the present value of this income stream, whatever it is, versus your investment on day one. And if the net present value is positive, which means that the value is more than the cost, you do the deal. If it's zero, you're indifferent. And if it's negative, you pass. Again, a very cut and dry discussion of an investment decision. Okay. How do I stop sharing this? Why do I have trouble?
Go up to the top of your screen and push stop share.
There it is. I'm sorry, wrong screen. Okay, I'll do a new share. So, so with that said, what I would like to do now, if I can get this right. All right, let's do it this way. Okay, can everybody see the spreadsheet, I hope, and my cursor? So we're just going to build a really quick down and dirty pro forma, and it is nothing more than recognizing income as it comes in and operating expenses as it goes out. So we're going to make it real easy. We're going to make it 3 line items. We're going to have income. So for real estate, it's rent. We'll have operating expenses, OpEx. And then we had net operating income. Or NOI. And basically, this is all a pro forma is, and we do it by periods. We go year 1, we'll do it on an annual basis. Year 2, year 3, year 4, and year 5. And we're going to say in year 1, rental income's $100,000. And operating expenses, let's say, is $60,000. So your net operating income is as simple as $100,000 minus $60,000. So your net operating income is $40,000 a year. And let's say that you have, and we do this a little bit of inside baseball stuff, but so we're going to escalate, or inflate is another word for it, annual income by 2% per year. So we're going to go $100,000 times 1.02. So in year 2, your income just went up by 2%, and we're going to extend it for the over 5 years. So every year your income goes up by 2% over the year before. On operating expenses, as a general rule, we like to inflate that a little bit higher than where we inflate income. It's the more conservative approach. So what we would typically do if we're inflating income at 2%, we would inflate income at 3%, so 1.03. So that's your 5-year period, and then again we'll calculate what the net operating income over those years, and that's your. This is a simple pro forma. Now, obviously, you can get as granular as you want. So for an apartment building that we do, we'll have base income, we'll have late charges. If we have laundry room, we'll have laundry income. We have vending machines, we have vending income. If we have meeting rooms that we rent out for parties and such, we'll have that. So you can expand the income.
Right. Hey, Louis, to that
yes.
point, not to cut you off. So some of these questions I'll try to ask in real time because they're applicable to what you're doing.
Sure.
There's a question from Melody. She said, where do property taxes get factored in? And would that be under operating expenses? Just like you said, in a full pro forma, it would be, line item specific, and then taxes would be factored in there.
Yeah, so that's a great question. It is an operating expense, so it would be an operating expense. To refine it a little bit more, a lot of times for multifamily, not for shopping centers or office buildings, but just strictly for apartment buildings, a lot of times operating expenses are broken out into controllable and non-controllable operating expenses. Controllable expenses are things like office staff, payroll, utilities, general and administrative expenses, banking fees, legal fees, accounting fees, all those, maintenance, all those are quote controllable expenses. Taxes and insurance are always shown on the bottom, and they're also always outside of a controllable because you don't control that. The taxing authority, they tax what they tax. They're going to send you a bill every year, and you're going to go X dollars in taxes. You can protest it and object to it, obviously, and appeal it and hopefully get a reduction in taxes. But you don't control that. It is what it is. In theory, some of these other expenses, you can hire more people, you can hire fewer people, you can pay them less, you can pay them more. All those things are within your control. So that's a great question. So again, this is your simple pro forma. You can do it, you can stretch it out to 10 years if we want. It's not that hard. Let's actually stretch it out to 11 years. Okay. And again, that's your pro forma. Ain't that hard. The art now comes into when you do your analysis, particularly if you're looking at a new building. Where are we here? So year one, how about year zero? And what's year zero? Well, year zero is when when you're building a new building, or you just bought an existing building that you're renovating, you're upgrading, and now you're in this lease up mode. And let's do a couple of more here. So we'll do year -1, year -2. Let's do it this way. So let's say it's a new building, new construction, we're going to build it. So, and we're going to start 2 years before year one. And I'll come back to why I do it this way. So in year zero, we're under construction. There's zero income. There likely will be zero operating expenses. So you have zero net operating income, but you're going to have equity contribution or capital. Again, we're assuming for the moment we're not borrowing any money to do this. We're going to do it all out of pocket because it's easier to think about it that way. And I just spent $2 million to buy the land and spent $3 million for construction. So that's year one. Or year minus two, so 2 years before year one. And then the following year, you spend another $5 million and you finish construction of the building. Now you're into year zero. So now you have the building, it's done. You're gonna, and assume for the moment that everything starts on January 1st. So now you're gonna lease up the property, and it takes you a while to lease up the property, but you end up leasing up the whole property. Assume it's at a steady pace in that first 12 months. So your average income is going to be $50,000 a year. Your operating expenses, to the point of that question before, your taxes, they are what they are. That isn't changing just because you didn't generate income. Okay. Insurance is the same way. Just because you didn't generate income or you didn't generate full income, it is what it is. Some of the other expenses are a little bit more variable. Utilities are going to be variable. Your staff is going to be maybe variable. You might hire fewer staff up front and then bring them online as you get a little bit fuller. You're going to have leasing expenses, which means marketing expenses and so on and so forth. So let's assume for the moment your operating expenses is still $60,000 average. So that first year of operation, you've operated at $10,000 loss. So where does that $10,000 come from? Comes from equity. Somebody's got to pay that and support that. So when you look at this pro forma, this analysis, if you will, basically, and I don't know that the numbers are going to work, quite frankly, so we might need to adjust it a little bit, but basically, this is your income stream, and that's your investment. Let's highlight that. That's your investment. Should we do it this way? And that's your income stream. Okay. Now, what we would do from here to help us make the go no go decision is we'll discount it back. We will discount this blue line here, which is your net operating income, and match it against your equity contribution and capital. And again, this is where you get your net present value, and where you say whether you have a positive net present value, you do the deal. A negative net present value doesn't work. Again, in the absence of mission-driven goals, that's the analysis in its simplest form.
Hey, Louis, so
yes,
to that point, there was a question that was asked earlier when the first time that you said that. So does being indifferent about this analysis essentially mean pass on the deal, or do you need to do further, analysis or investigation and decide?
So when I say indifferent, it really is a black and white mathematical decision. In theory, any net present value over zero, again, means it's a positive net present value, and you'll end up, even if it's $1, it says you'll end up with $1 more than you had before. Now, this is not adjusted for risk. which kind of, again, adds another layer of it on top of that. But again, if you're zero, it's indifference. And the indifference is, would I rather have the $10 million in my pocket today, or would I give you that $10 million, and in return for that $10 million, I collect this income stream over the next actually 10 years? And there's a reason why I do it for 11 years. Okay. When we do the net present value, so we don't know how long we're going to own it. So there's a convention within the business that the assumption is you're going to sell it at the end of 10 years. And the sales price at the end of 10 years is based on the NOI, the net operating income in year 11, divided by what we call a direct cap rate. Okay, the direct capitalization. So if you recall earlier, the six functions of a dollar, the present value of annuity in perpetuity means you're going to collect. So what this says here is, if I collect $41,264 to the end of time, and my required return, or the next owner's required return, because you're going to sell it in year 10 based on year 11 income going forward, is 10%. The direct capitalization says you take 41,264 divided by 10%, and it's worth $412,000. That's the sales price. That is the direct capitalization approach. Okay, and then you would add that to year 10, and then you would discount the entire income stream back to year 1. And that gives you your present value. And if that present value is greater than this $10 million or this $10,000 that you invest up front, you do the deal. If it's less than that $10 million that you've invested up front, you pass. Again, on a purely mathematical exercise and approach. Okay. Year 1, this year here, the significance of this year, right? This is year 0 is lease up. We have no idea. You know, the building started empty on January 1st, and on December 31st of that same year, we end up being fully leased. Year 1 then is considered to be your first full year of stabilized operations. So the property is stabilized. If you look at it again, based on the projections, going forward in year 2, 3, 4, 5, and 6, it's just an inflated amount from whatever you have from year 1. So year 1 becomes your base year stabilized operation. Why is that important? Because the down and dirty way of doing it is what we call the back of the envelope approach of analysis. Doesn't talk about timing, doesn't talk about risk, does nothing. It is the first step that I do to say, is it worth my time to look even further? So what usually happens here is this applies mostly where we're looking at an existing building that's on the market for sale. So some broker is going to put together this really fancy and slick brochure with these really rosy projections, and they're going to say, hey, you're going to generate $2 million a year in net operating income for the next 5 years, or the next 10 years, next 20 years, whatever. And so I take him at his word for it, and I'll take this 40, let's say in this case is $40,000. And similar to what I did in year 10 and 11, I'm going to say, okay, assuming that this $40,000 is steady to the end of time, what's it worth at 5% cap rate? So I take this $40,000 divided by 0.05, which is the 5%, and it says it's worth $800,000, but the broker says it's on the market for $2 million. I pass. Now let's say the price for the sales price for the property is a little closer. Let's say it's $850,000. Something to think about, right? At that point, then I'll say, then it's close enough for me to warrant spending more time to investigate and say, okay, are his numbers right? What's his plan? How is he coming up with these numbers for the projections going forward? And because I am a developer and we're all arrogant, can I build a better mousetrap? Can I improve on his numbers? Can I find value that's hidden in there that this broker is too stupid to see, and therefore I make money?
Hey, Louis, so another question kind of on that vein. So there was a question from Bruce that said, guessing the 10-year sale is for market rate and not for a LIHTC project.
That is a great question. So on a LIHTC, you have a 15-year compliance period. You're not selling it within that 10-year period, but we still value it the same most of the time, because we have to figure out what the value of the property is, what the value of the asset is. So under a LIHTC scenario, between years 10 and year 15, you're not getting out of the deal. But the thought is always when year 15 comes. So when you're in year 13 of that year 15 of that 15-year compliance period, you're starting to think about a resyndication. At least I'm sorry, let me rephrase that. We at Enterprise think about a resyndication. If you're a for-profit developer out in the world, the decision actually then becomes, depending on what other financings is placed on the property and what other restrictions, the decision then becomes, can I convert it to market rate? And you start looking at that in year 12, 13, 14. You start looking at that then, and you would run the same analysis, and then you would say, okay, it doesn't really matter what the property's done in the past. The question is, what are the rents today, market rate rents? Would my operating expenses be the same, or would it be more? To the extent that the property is now at least 15 years old, if not older, depending on when it was built and how many resyndications occurred, how much money do I have to put into it to achieve these rents? Right?
Yep. Hey, and then there was a question from Sean, so hopefully you will remember. She said, could you put what the numbers you just calculated represent? And Sean, you might want to type in a little bit more clarity on that if you forgot what you were doing, Louis.
So I don't, I'm sorry, Tim, I'm not looking at that, so I don't see what what's being typed.
She said, could you put what numbers you just calculated? It goes the 800,000.
So, all right, so this equals value using the direct capitalization method. Okay, so that's where and it is the $40,000 divided by the capitalization rate of 5%. I don't ever get these cursors back. Oh, there it is. Okay, and the capitalization rate means your required rate of return. So what that says is if you know you're going to get $40,000 a year forever, and you require a 5% return on whatever money you invest, you're willing to invest $800,000, and it will generate 5% per year forever. That's that concept. I mean, does that really happen? No, of course not. But that's a way for you. It's a convention that allows you to compare between this opportunity, this investment opportunity versus another investment opportunity. And this concept, getting back to the question, this concept about a sale in year 10, that's an appraisal convention. You know, all appraisers do it that way. All lenders who underwrite debt, if you're going to borrow money, you're going to try and borrow money. Lenders use that year 10 sale as well. You know, can you go longer? Yeah. Can you go shorter? Yeah. But if you go shorter, you don't have the benefit of the cash in the intermediate years, so your value tends to be a little bit lower. If you go longer, you do have that additional cash over the years, so your values tend to be a little bit higher and it gets inflated. So you know, those issues exist using the 10 years as well, but to the extent that everybody uses 10 years, for the most part, the relativity aspect of it kind of washes out, and you're comparing a little bit more apples to apples in terms of a hold horizon.
Yep.
This doesn't mean you have to sell it in year 10. This doesn't mean that, again, affordable housing aspect of it aside, if this was an office building and the market gets really hot, somebody may offer you stupid money in year 2 to buy the property, and you say, sure, yeah, I'm out, and you move on. Again, these are all projections. These aren't predictions, and it doesn't, it doesn't mean it comes to pass. Often it does not. If I get my number close in the first 2 or 3 years, I'm really happy. And on a few rare occasions, every once in a while, we actually outperform our original projections in the first couple of years, and then we're really, really happy. Yeah, doesn't happen often, but it does. And again, this is not necessarily within the context of affordable housing. This is just a approach to real estate investment analysis. Affordable housing kind of has its own issues. Part of which is, as you know, we charge less rents. So if you were to do this analysis on an unleveraged basis, which is what this is called, leverage is when you secure debt, then it's a leveraged transaction. When you don't use debt, and it's all coming, you're just writing a check for all the costs. That's known as an unleveraged transaction. Doesn't happen that often because leverage is, generally speaking, a good thing. But if you were to do this exercise for a true affordable housing development, and we do this all the time, these numbers never work because you're charging less rent. You're charging rents for 30% AMI families and households, and 40% and 50% and 60%. So by definition, you're not achieving market rents. And yet at the same time, your project cost, your cost of construction not only costs the same as a market rate development, a lot of times it ends up costing you more than a market rate development for a variety of reasons, not the least of which is if you end up taking public funds, you're subject to, if you're taking federal funds, you're subject to Davis-Bacon wage rates. If you're taking state funds, most states will have all these sustainable design, green building design requirements, which are all good and worthwhile, but they add to the cost of the building, and those costs are, generally speaking, on a pure dollars and cents perspective, they're not accretive. You don't recover that. So you reduce electricity by X dollars per year, but you just spent 3 times X on the windows because the windows are more energy efficient.
So those 2 additional questions came in. The first one, I think you touched on this, but is depreciation relevant to this analysis?
No, because depreciation is a tax construct. So depreciation serves to reduce your taxable income. If you were looking at it, I mean, to be fair, if you were an investor, you would look at it on an unleveraged basis first. You would look at it at a leveraged basis, and then you would look at it on an after-tax basis, which is where depreciation comes in. And what depreciation does is, because it reduces your taxable income, it reduces your tax burden, which improves your cash returns for those periods. But then at the end, if and when you exit the deal, when you sell the deal, then you have capital accounts that you need to deal with, and you have recapture and yada yada, yada, all that stuff. So that's where depreciation comes in. In the initial analysis, I never look at depreciation. That always comes kind of way down the end, if at all.
Mhm. Gotcha. The second question, I'm not sure how easy you can do this, but it says, and this is from Bruce, in this case, it seems like the 10 million capital contribution does not tie to the income / capitalization. Might be worth adjusting the capital to show the relationship.
Absolutely true. These are numbers I just made up and pulled out of thin air. So I always pick 10 million because it's easier to use. But the reality of it is, if I'm looking at a $40,000 a year stabilized NOI, again, this project probably is not worth much more than $1 million. So if I was buying an existing property, it's $1 million just based on these numbers. So I don't disagree with that at all. The importance of having and showing it this way, and I don't want to get into it now because it's really a much longer discussion, is this is what you do to calculate your internal rate of return, IRR, which is what investors look at. So investors always want to look at what the negative outlay, the investment, is upfront, and then your cash coming in over time, and then you calculate internal rate of return. So it's always important to have your initial investment. Which is the reason why I showed. Again, this is all driven by pro forma. And the reason why I show this is I really want to highlight to you the importance of the pro forma. Not as a pro forma so much. Again, it's nothing. It just tells you what you think you're gonna collect, what you're gonna spend, and what the net is over the period of time. It's how you use it. You use it to calculate your internal rate of return. You use it to calculate your net present value. You use it to calculate your kind of point in time value using a direct cap method. So we can go look at this and say, okay, if I had to sell in year 4, what can I sell it for, assuming these numbers are right? So I would go to year 4 and I would do the same exercise here for 800,000, but instead of dividing 40,000 by 5%, I would divide in year 4 40,557 by 5%. So I would say in year 4, I can sell this for $811,000, but that's in year $4. So now I would take that back, I would discount that back to today and say, okay, if I sold it in year 4, what's it worth to me today? Which is, again, the present value of a future value, right? That's the exercise. So the future value is $811,000. The present value would be whatever that is, discounted at whatever rate that I think is the rate. And again, we got to think about what's my alternative investment option. So if I had whatever the dollar it translates to today, and I put it in the bank, what rate would I have to earn on it in order to get to $811,000? And again, that makes, and at the point where they're equal, in theory, I'm indifferent as to whether I sell it today or sell it in year 4 and collect the cash in between. So it's not as cut and dry and difficult to kind of impart in an hour. But again, my hope is it kind of shows you kind of things we look at, and all of this again is colored by the mission. Is the mission served? Is it served even though there's a slight loss? Is that loss worthwhile? Again, those are frankly, those are decisions that are made at a pay grade level way above me. I can only present it and say, this is what the numbers look like. How do you want to proceed? And we will do deals with that maybe doesn't make financial sense. Can't be hugely out of whack, but if it's close, and it serves the mission, that's a discussion that we have in a decision that we make, yay or nay. But if it's wildly off, it's not sustainable, and it's just not a prudent organizational decision to make.
Louis, so there's a question from, I think it's Shikia. If you were planning to sell in year 4, wouldn't you use year 5 NOI to determine the sales price?
You can. I was pulling that as an example. So if you would use year 5, if you wanted to calculate what the sales price was for in year 4 and what the present value of that sales price plus the previous 3 years or 4 years of income. So you would take this analysis that I just did, the net present value analysis over 10 years, and you would shorten it to 5 years, but with the 6th year added or the 5th year added to calculate the sales price. So that's a great observation. Were there any other questions or thoughts or?
Louis, I don't see any additional questions in the Q&A, but if you're done with the presentation, I guess we have a few minutes for additional Q&A if folks want to put them in the chat or in the Q&A. I can grab them.
Sure. Let me stop the screen share.
Let's see, a question came up, I believe. Will the presentation material be sent to us? Yes, it will be. We'll send the recording and material to you. And we'll also place it on our website on our resource page.
Great.
Any other questions? Well, if not, Louis, anything else you want to part on?
Nope. I appreciate the opportunity to share what I know with you. I hope I didn't confuse too many people too badly. It takes a little bit of time of thought, and again, I deal with it on an everyday basis for the last 30 years, so it's a little bit more second nature to me, obviously. So if I've glossed over some stuff, my apologies. It just doesn't occur to me quite as much. So, but again, happy to respond to questions. If you think of questions later, just direct them through Tim, and he'll direct it to me, and we'll come back the same way.
Right. Well, thank you so much, Louis, for all that you do for Enterprise, for accepting my request for support, and for sharing some very, I think, informative and helpful tidbits. I think there was a lot of great questions asked, so hopefully you were able to shine some light on those. And again, how you approach it to using this as a tool in the development process. So we appreciate that. I'm confident that our participants learned a great deal today. In closing, I want to once again remind participants that Enterprise continues to believe that houses of worship and the faith community can play an important role in addressing the affordable housing crisis by utilizing your undeveloped or underdeveloped land that you own to provide affordable housing units. And we're here to help you figure out the housing development piece of that through our faith-based development initiative. There continues to be a few different on-ramps as it relates to our FBDI program. If you're a house of worship that feels it's further along in the development process, then we have a organizational assessment / joint venture worksheet that Enterprise developed that might be a good next step for you to complete so that we can get a better idea of kind of where you are with your individual project and how Enterprise and our partners might be able to support you. If you want to get a copy of that organizational worksheet, please reach out to me directly. I think my contact information is on the slide. If you're still trying to wrap your head around the development process, because I know it's a lot to it, then continue to participate in our FBDI webinar series. Might be where you need to be right now. Our next webinar will be on Thursday, June 24th, where we'll discuss innovative development models and building community support. We'll take a closer look at the community land trust model and co-housing. So if you're interested in that and how you build community support for your potential projects, then that webinar is right for you. Thank you again for joining us today, and have a blessed rest of the day, everyone.